Hello everybody, welcome to Talking Automotive with Mark and John. My name is John Sinclair and my co-host Mark Palavestra.
Hi John. Today we have a look at our predictions for 2021 and how our scorecard performed in the first quarter. Are we right and are we wrong? So the numbers look pretty impressive when you look at what we've covered off.
Definitely an interesting year this year, and it's going to be fascinating to see what happens going forward. Let's jump into the discussion.
With 30 years' experience in auto logistics and state-of-the-art locations in 5 major Australian cities, PreCar Fleet Services is an independent division of PreCar Services, offering specialty fleet fit-outs for commercial applications ranging from simple tray and tow bar fitments to fully bespoke service body and accessory installation. With quality-assured safety, compliance and standardisation of vehicle builds, PreCar Fleet Services are a premier all-in-one solutions provider for commercial vehicle fleet operators, leasing companies, and original equipment manufacturers. For further information on how PreCar Fleet Services can assist in solving your commercial vehicle fit-out needs, please visit precar.com.au and click on the link to Fleet Services.
Okay, Mark, I was pretty impressed with your figures. You know, we did the recording last year and you called the numbers and you put a stake in the ground of what you thought the numbers would be. And you had them down to a T. I was pretty impressed with that. So maybe, Mark, can you describe the current state and what led into that current state and where do you think the future is going to be?
Absolutely, John. It's when you look at the current state, future state, and our prediction, I suppose the best thing is to look at the industry as to what the key metrics are, but not from a traditional OEM perspective. Normally, you'll sit through many an OEM presentation, and it's the same stuff that keeps getting regurgitated. Today, we're just keen to cover off just some of the basics that most people may not be aware of. If you look at the overall car park, there's 19.8 million cars on the Australian roads. And when you look at the population, we've got 25 million people, but there's actually, when you take out the people under 17 and over 90, it's kind of interesting that we have 19.838 driving age people in Australia. So there's a gap of 38,000 units versus the number of cars that we have. So there's pretty much a car for every driving age person. And we know that there are some that don't drive, and we know that there are those that have multiple cars. So when you look at it, we are in balance. If you look at the average number of new cars over the previous 3 years, take out the COVID hiccup, but it's been around about 1,050,000 cars. If you go back to 2013, it was actually well over 1.1 million per year. And then last year, we dropped down to 916,000. There was very much a imbalance, if you like, to that supply. And you look at the average age of the cars that are on the road, from what Stuart was giving, 10.4 years. Very similar to the US. And David Kane gave us that statistic, that it's very much in line with what we have from a 10-year perspective. The cars come on, we also have cars coming off. And if you look at the information as to what vehicles get either turned into scrap or dismantled, it's around that 800,000 units a year. So normally we have a situation where we have a net immigration surplus of over 300,000 people. We know that there's a large proportion of those that are adults that need vehicles, and those immigrants buy cars. So at least 200,000 of those will buy cars or need existing cars. And there's that fun fact that we got from Ben Sullivan that more people over 70 buy new cars than people under 30. So with the average age of the new car buyer being 50 years of age. Now, also, when you look at the sales channel mix, when we look at the mix of private and fleet, etc., we always talk about a 50-50 split, but it's actually not quite that exactly. And in a normal year, we know that there's 49% to 50% private, and the fleet number is really 36%. And the other 15% is a blend of company cars or dealer demonstrators. What we did see is there was obviously a push pre-COVID with a lot of pre-reported cars. There was an oversupply and there was a lot of push through the network. And the VACC conducted a survey across all their brands of their members. And the data indicated in the 2018-2019 period that there were demonstrators up to, or pre-reported cars up to the range of that 28%. So that's where you get this big push situation and then discounting, and that then has an impact on residual values. But then you look at retention. So private buyers retain their cars for 7.8 years on average, and fleet buyers retain their cars for every 4 years. A lot of that's because there's like commercials and they've got to amortise their other fit outs. And dealer demonstrators are that 90-day on average turnover. And they're the cars that come back in and are those value used cars, price pointed cars that turn over a lot quicker. But something's really hurt us this year, and with the pandemic, is this whole product and where we get our cars from. So we get the majority of our vehicles from the Asian area. So Japan, China, Korea, and Thailand, with some cars coming from India. But that's the majority of our supply chain. And then you get the outliers, which come either from the US or from Europe. And those lead times are significantly longer than what we have from the Asian side of things. When the last recession that we had, or hiccup that we had, which was the GFC, we still had 3 manufacturing plants here in Australia. Well, what did happen is once we rebounded from the GFC, those factories ramped up, supply was quickly replenished, and we had stock. This time around, it's very, very different. We have consecutive and repeat second and third waves of lockdowns occurring in Europe and also in the US. So supply is significantly disrupted. So this is where, if you look at where the opportunities, who's going to rebound faster, which brands are going to rebound faster, you need to look at where those cars will come from. Now, the other thing is we've got a changing preference for SUVs and LCVs away from passenger cars. So passenger cars now only account for 23% in total, and that's hatches, sedans, and wagons. 23% are light commercials, and these are those medium pickups, primarily that come from Thailand. And there's 3% that are trucks, but 51% are SUVs of some sort. And this is the big question that came up when we talked about EVs. EVs are primarily in that 23% bucket. So the smaller segment of vehicles are the ones that provide EVs. Yes, there are EV SUVs in the market, but only a very limited number. And yes, they are very expensive. There'll be more coming, and the adoption and the opportunities lie there as to who can supply cost-effective SUV EVs. But yeah, it's interesting when we look at that, where we get our cars and what we actually buy. And the other thing that was a big issue is exchange rate. Previously, when we manufactured here, exchange rate was a factor, but it wasn't everything. Whereas now, the A-dollar and a falling A-dollar increases costs. And we saw the A-dollar drop from 2018 all the way through to 2020 significantly. As a result of that, also the financial constraints gave us a lot of problem as far as consumers being able to finance cars. And there was a lot of stock around, so a lot of discounting, a lot of pre-reporting, and there were a lot of cars in compounds aging. So there was a lot of push. At the same time, we had 60 brands, and this is where the Holden was in the last days of being here in Australia, and they were heavily discounted because they had a lot of volume commitments that they needed to push out. And used car prices were hurt. Dealer profitability, with the pushing, dealers weren't making money. So that's when there was a need for a review of what we do from an agency perspective. How do you get dealers to be profitable, and how can you actually have a sustainable dealer network? Then on top of all those big challenges, you had this massive COVID hit. But then there's been an upside. The dollar rebounded. The OEMs aren't absorbing as much of the losses that they were previously. But then there's the challenge, they can't get supply. Now, there's a lot of cash that's flowing around the economy with government support. There's access to super, there's stimulus packages for instant asset write-offs, and there's used car demand because there's just not enough supply, and people want to also make sure they avoid public transport, or have been avoiding public transport. And there's no age stock in the compounds. Prices actually have gone up, and they've gone up by $5,000 on average for a new car. So the median price has gone from $45,000 to $50,000. So when we looked at the numbers and we sort of forecast, well, if we did 916,000 last year, where do we go to this year? And what is the number? What are the key drivers for that? Well, building and the demand's continuing, less discounting and plenty of demand for LCVs. There's still no international holiday, so motorised self-travel is a key driver. So boating, fishing and camping, SUVs and LCVs are in demand. And also there's a lifestyle change, rural tree changes and sea changes. And no surprises, in the aftermarket, there's plenty of demand for roof racks, tow bars, bull bars. They're all in short supply because, once again, the supply chain was not expecting such a huge spike, and those lead times are many months before you can actually get these type of accessories in production and also in market here. Now, we're now seeing that domestic airlines are flying, and there's now some domestic travel between the states have opened up. So there's more demand for rent-a-cars. And there's a change in dealer distribution model with agency coming in across a number of brands. And there are other brands that are well and truly putting the building blocks in place so they can roll it out in their business models. So when we looked at the number from the 916,000 that we did in 2020, month by month, segment by segment, what does the number work out to be? And that number came out to be 1,112,000. Now, a lot of feedback that we got were that, geez, that's way too bullish. When we looked at and we actually forecasted by month, and you look at the 2020 volumes versus the 2021 forecast that we did, the January-February numbers were very modest predictions above what last year was. But still, ironically, we were a little bit out. The big hits that happened last year were in March, April and May, where the first wave of COVID activity hurt from a sales perspective. And the second wave that hurt was the second wave in Victoria that impacted the August, September, October. Other than that, the other months were quite normal versus previous years from a volume perspective. And when I say previous years, not 2019, previous years, you need to look at 2017, 2016 for a normalisation of volume. It's around that 1,050,000 a year. So if we're under by 100,000 from the 1,050,000, this year is a year of make-up and catch-up. So when you look at the forecast, it's very much that March number of getting to 100,000, April being 79,000, whereas last year was 38,000, and May being 96,000, once again a normal May, versus the 59,000 for the previous year. And then June's always around that 110, 120. And then the August, September, October number, getting back to normal figures. When you really do a deep dive into the Q1 result, January we forecast 74,500 and the market actually came in at 79,600. The big differentiator was 5,166 units that were mainly a result of passenger being down significantly, but SUVs jumping from 36,000 to 41,000. LCVs kicked up by just under 1,000 and the heavy commercials were up by a couple of hundred. So we weren't far off the pace. If we look at the February number, we forecast 83,000 and the actual came in at 83,977. So 977 out, not bad, but once again, the passenger number was lower than what we forecast. So it's not rebounding as quickly. Passenger dropping away, SUVs taking up the slack. And if you look at the March forecast, we're looking at a 23,000 forecast for passenger. It only was at 21, but SUVs went from 49 to 51,000. And light commercials at 24 to 23,000. So we were pretty much right for LCVs and the heavy commercials. So 100,700 versus 100,005. So for the quarter, our predictions are out by 5,400. Not bad for a 263,000 market, and we're on the low side. All things being equal, our prediction of 1.1 number is very much on track to being achieved. So, John, I'm keen to get your thoughts on where you see the opportunities and threats going forward for this year and into next.
Yeah, Mark, there's going to be a number of opportunities and threats. And I think the first one I'd like to highlight, I think there's going to be the rise of the Chinese brands. But I think you're starting to see the new Chinese brands coming in. They're starting to get a strong foothold, like brands like MG. They did really well in the first quarter. Part of that might have been a lack of stock due to other brands. The figures are the figures, and at the end of the day, if you have the cars there and you sell the cars, it's all good to you. So you got Haval, you got LDV starting to make strong inroads into the market, and as they gain more success, I think you're going to start seeing other brands coming in from China. The other big thing which I think is going to play a big role is the electric vehicles, because there's 60 new EV brands in China, and as you see this agency model coming through, I think they're going to see that as a huge opportunity to come in and attack the market aggressively. They're going to have no traditional franchise networks they have to worry about. They don't have to compensate dealers for investment that they've done over the last couple of years. So they can come in and aggressively challenge the market. The second thing is where the Chinese brands have a big advantage is they're very close to Australia. So short lead times, short shipping routes to get to Australia. So the cost to get the vehicles here is a lot lower. And as those margins compress and it becomes more competitive, going to provide a big advantage to any of the Asian brands, especially brands trying to come into Australia. And if they're competing against American brands or European brands, long distance to the market, they've got an extra 4 or 5% of cost, which they have to absorb in competing in the Australian market. So Mark, what's your view on the Chinese brands?
I agree with you, John. I think and if you look at that chart that we showed with the supply lines and how quick it is to get stock out of Asian continent into Australia, that is the future for this country. The Australian auto industry has gone through this wave of decades of dominance by certain brands or certain themes. So the 1980s was the Ford decade. The 1990s was the GM Holden decade. The noughties from 2000 to 2010 was very much Toyota asserted themselves with their dominance and were very, very strong and have been very strong ever since. However, we did see a trend and there was a rise in the European brands in the teens. So if you go from 2011 through to 19 and 20, the Euro brands accelerated. The premium brands became very, very, they started attacking the mainstream from a pricing perspective while still maintaining their premium edge with some very exciting product. And the affordability, and there was a lot of there were more masstige European brands. Yeah, Volkswagen doing exceptionally well, and the other Europeans coming into play as well. This decade, I agree, this is the decade of the Chinese brands, and we're already seeing it, right? MG is doing very well, LDV are doing very well, Haval are doing very well, and GWM have got some very good product offerings. The warranties are very good, and you're right, the proliferation of electric cars and making that affordable SUV attainable in Australia is the one that's going to be the tipping point that's going to really accelerate the EV take-up. So the loss of Holden should not be underestimated because that's a huge opportunity. There's a lot of volume. It's a top 10 brand exit a country so quickly, leaving such a gaping hole in volume for others to fill. Now, when people talk to local manufacturing closing, that was not the gaping hole. That it was just one product that disappeared. The gaping hole is when an entire brand disappears. There was a large player in fleet. That needs to be filled. So I see opportunities for proactive OEMs to actually take advantage of that because there are many customers that are looking for more competition in that area because right now there's less, and as a result, they've got to either wait for vehicles or pay a premium.
Yeah, Mark, I also think with the agency model coming in, that's going to change the whole dynamic of that whole franchise environment. Previously, for a franchise distribution network, you had a lot of dealers covering a large amount of areas. There's huge investment in signage and standards and infrastructure. That's all going to change because that whole sales side is going to be reduced to maybe fewer sales distribution centers and a lot of sales being done online. So that's going to take a lot of cost out of the model. There's going to be a reduction in showroom sizes and showroom facilities and that you've previously had. It's going to be moving more to test drive centers, distribution centers, where the delivery of cars will be done. So the whole dynamic is going to change and that's going to squeeze the margin quite extensively. So that whole agency model is going to provide some opportunities, but I think it's also going to allow the threat of other brands to come in the market following an agency type model.
Oh, definitely, I agree. And that was a very good discussion with Peter and the South African experience, with the experience that they've already seen with the agency model and the next wave, which is the full omni-channel way of buying vehicles and selling vehicles, which is going to be a revolution in the auto space. It's interesting also, right now our borders are closed. So as I mentioned earlier, we have a net migration surplus of 300,000 immigrants, of which around 200,000 will buy cars of some sort. So this is where I see the used car prices still being strong for quite some time, because even though supply comes back on board, we will also increase the demand by bringing more people. So that immigration thing can never be underestimated. Now, the fleet side of the business, there's plenty of opportunity there because fleets actually delayed a lot of their changeovers with vehicles through last year. And there's a lot of money being spent on infrastructure, and there's a lot of infrastructure that needs to be built and serviced through like commercial vehicles that need special fleet fit outs. So that side of it and getting them done, off-wharf and having a good standard of fit outs, very important.
But I think, Mark, you also need to keep in the back of your mind, depending on how quickly the supply of vehicles come back, and if we get into a situation where we're trying to drive volume again, as what was happening in pre-COVID, it could impact residual values because you might have a lot of used cars getting changed over and coming back into the market. So I think that is something dealers need to be a little bit aware of. And towards the end of the year and early into the first quarter, they just need to keep an eye on that about how they're trading, because what you don't want to do is end up with a whole lot of vehicles that are overpriced on your lot, because they'll be difficult to get rid of.
The Australian dollar dropping will be a huge issue going forward. Right now, it's rebounded to be at a strong position, 75, 76 cents versus the US dollar. But there is a risk with the US government pumping money in that the Federal Reserve may look at inflation and say, right, house prices are going crazy in the US right now, just like they have done here. Is it time to start moving rates up? As soon as the US rates go up, the US dollar will get stronger again, and that will then put pressure on the Reserve Bank here to put rates up as well. That's going to be an impact to get that all-important A dollar to maintain a nice steady 75 cents. When it drops down to low 70s or in the 60s, that's a real problem. Manufacturers absorbed the costs previously. They're not going to do that again. Right now, they're in sustainable mode. Otherwise, we'll be taking more price again. There'll be more price pressure, and there'll be even a risk of maybe some of the OEMs exiting like Holden have.
Yeah, the other problem you always have too is a lot of the banks source funding out of the US. So if those interest rates start hiking, the local interest rates are going to start going up too. So there is a risk of that.
Indeed, very interesting times. The semiconductor challenge is going to be a bit of short-term pain. We're hearing that there are still a number of brands that have impacted and can't get enough of the semiconductor supply to meet the demand for manufacturing vehicles, because there's still plenty of demand for phones and gaming devices, etc. And what are your thoughts, John, on the factories? With you're well versed with supply chains and manufacturing and who supplies whom the quickest or last. I still have my concerns that may still hurt us for a bit.
Yeah, I think it's always a big challenge we have in Australia, because local manufacturing in Europe or US will always fill their local market first, because they can sell those products quickly, get the cash back in the bank. From a cash flow point of view, you don't have a choice. Whereas if you put it on a boat, it's probably 5 weeks shipping time to Australia, then a week or two while it gets distributed out to dealers. So you're losing nearly 2 months before you get that cash back in the bank. So it's definitely, they will fill their local markets first. And now that we don't have any manufacturing here, that is a risk. So I think that will continue for some time, because we still don't know what's going to happen on COVID or some of the European markets. You've got chance of factory closures again. So definitely a worry, but we'll have to see what goes from there.
All things being equal, if you look at those opportunities, that 1.12 number we're very much on track to achieve.
Yeah, Mark, I was very impressed at how close you have been to get to that target. You originally put your flag in the sand of 1.1 million. I was very skeptical. I didn't admit it to you at the time, but
Thanks,
I thought
John.
it was a big call. I think it's a good call, and the more as we get into the year now, I think you're pretty accurate with the figure.
Well, the beauty, John, is, and hopefully for those that listen and watch our podcast, is that in the guest speakers that we bring onto the show, when you actually piece together all the key or the core elements of what each one provides and actually put it in a summary, it actually gives a very concise but also complete overview as to what is actually happening in the market here, other than what the traditional stuff that you see, this is what happened in VFAX, or this is what happened from an interest rate perspective. There are a lot of elements, a lot of moving parts to this to predict what that number will be. So I'm still very confident that it's a 1.1, and I think next year will be around that 1,050,000. So it probably will come off a little bit off next year. But it all comes down to what the Reserve does, and also what APRA do from a responsible lending perspective if they make it hard again to get finance. But whilst money is flowing around and whilst consumer confidence is up, no one's getting sick, no one's dying, no one's getting sick with COVID, no one's dying of COVID, and there's no restrictions, people are feeling good about themselves. They've saved a lot of money over the last 12 months. It kind of just goes to show how much money leaves the country through international travel and spending, or spending on discretionary items locally that you may not have been doing previously. It's hurt those businesses, but it's helped get household finances into great shape.
Yeah, thanks everybody for listening. If you have enjoyed what you've heard, please subscribe to our channel on YouTube or ring the bell below. You can follow us on LinkedIn. Please like our announcements of the show. We're also now on Patreon, and we're also on Spotify and iTunes. So thanks very much again for listening, and we'll speak to you next week.
And John, don't forget, you can shout us a coffee. So if you're not on Patreon, you can go to shout us a coffee. It'd be great to have a coffee with you.
Now, Mark, the big question I want to ask you is, we've now been doing the podcast for a year, and how have you felt going through the whole podcast?
1 year, almost our first year anniversary. When is it actually? It's coming up next week, isn't it? Because the very first one I think would be actually now. It would be up for 12 months. So, John, 12 months of podcasting. I've got to say, I've had an absolute ball. We've had some fantastic guests, and the subject matter has expanded. I thought I knew a lot about this industry, having worked in it for 40 years in a lot of different areas. But the caliber of guest and the subject matter that they've covered has been exceptional, and I've had an absolute blast. But hopefully we've provided some value to our listeners and viewers.
Yeah, Mark, that's what's really amazed me, is how much I've learned. Because every podcast you get on and you speak to a new guest, and it's amazing. They've got such exceptional knowledge about their topic and what they're talking about. So to me, it's each podcast I learn a huge amount, and it's been a fantastic year. We really enjoyed it. I think we originally set out to do 6 podcasts. I think that was our initial, when we had the COVID lockdown, we said we'll do 6 and then see what happened from there. And now we've done 38.
Oh, absolutely. A lot of fun, a lot of great guests, some really good feedback from our viewers and also listeners, which we've appreciated, we've taken on board. Hopefully we can still continue with providing good value and information to this industry. It's something that we're very keen to give back to this amazing industry that's given us so much joy over a long period of time.
And the great thing with the technology nowadays, we can speak to anyone, anywhere around the world and have instant input into automotive, which is a pretty exciting industry. So it's been great talking to everybody.
Absolutely, John. As I always would say to any of the up-and-coming proteges through the businesses that I've worked in, is one thing about this auto business is it beats selling washing machines.